podium.
Okay, I'm going to pause this. Well, I'd like to welcome everybody to class today. We are again honored to have Mr. Max Lee with us again, as well as Daniel Lynn, our tech TA. And I assume everyone has read the FX trading handbook, which we put today. And if you have not been in practice entering orders to trade foreign exchange, then this document will give you some good examples on how to do that. But with no further ado, I'm going to introduce Max Lee, and he has also brought a guest speaker, Atif Malik, and I'll let him tell us about that. So come on up, Max.
Sure. Guys, good to see everyone again. I appreciate the people that came out in person in the rain. So we had some Zoom participants as well. And I think Atif, are you on? Just so I can say he said it was on. Just trust him.
Good afternoon, Max. I am here. You can hear me.
Perfect.
All right.
So he's on. So like we always do, except for last week, try to have a market of interest. And Atif will be able to speak about this one quite a bit. But so something, since this is FX week, the one that has been most of our raters for work as well as personally, we've been looking at the Turkish lira. So this is a street grids of the spot flat price as well as the 1 month points, and we'll get into what that means. But it's been something interesting. I mean, we've shown kind of like, again, some of the volatility in the FICC asset class, and the idea being that,
you might want to reshare this PowerPoint screen. It kind of like it disappears with Zoom students.
Oh,
yeah.
We got to reshare that. Sorry.
Yeah,
Max.
no worries.
Yeah, it stopped sharing when I did this.
Okay.
Now, do I want to share Malik?
Oh, yeah, you can drag this thing out. Yeah.
I can drag him over at the when he goes
Yeah.
When he comes on. I'll exit out. So anyway, so this is the the USD exchange rate versus the Turkish currency, and so there's been quite a bit of volatility in the last 2 years. Obviously, of COVID, but on some of the idiosyncratic side, obviously the president there is a little bit borderline totalitarian, and so this has actually really exploded quite a bit. And the street tends to be, at least from the investor side, very one direction in the sense that a lot of your traditional plays in the FX market, from like a carry perspective, a value perspective, all are long the lira, and so this market has been kind of a one-way train, as well as being sort of extremely illiquid to actually execute. So anyway, it is something that's been interesting. It's been evolving. There's been some headlines. I think there was one over this past weekend in the sense that he tried to expel, I think it was 13 Western ambassadors, and so that's kind of taken us another leg higher. But anyway, again, just looking at the volatility, I mean, this thing was at 7. It moved about 10% this one day here in March when he fired Erdogan fired the existing central bank governor, and you can see the spot price moved about 10%, but the forward points, and so this is effectively the cost to hold that currency further in time, jumped about 6 times. So just highlighting again some things that you don't necessarily see in all of the in all the literature, things that show up on Fox News and stuff. But that is our market of focus. So from last time, we didn't do this last week. So in the last 2 weeks, we had commodity asset class overview with Billy about 2 weeks ago, and then we had the buy side week last week with McCool and Thompson. I think just some of the key things from the first week was the idea of like commodities being a little different than equities. How do you view a FICC market versus some of the more traditional stocks? What are the opportunities? Again, I think that what I hope you get from this week as well as you compare it to last week for those that were here is that, there are the way that sort of quant trading approaches a market should be very generalizable. I mean, in the sense that, you don't necessarily have to be an expert in that specific asset class, no matter how large, right? And so you can approach commodities in a similar way that you approach FX, that you approach credit, that you approach stocks, and then building, I think, that network of information and sort of the domain expertise, like Atif is for FX and Billy was for commodities, is very helpful to helping you scale. If you think about, then we move forward to what Thompson does, Thompson manages his institutional money. He has a VAR allocation, a notional allocation, and his day is there to sort of think of ideas, but he's not going to know the ins and outs of all whatever number of markets it is he covers. And so that's an important thing. And you'll see that the way that I describe the FX market is going to be fairly high level and sort of introductory, and then Atif really is kind of that expert. And together, I think he helps us in a lot of ways, especially if we manage our own risk. Other takeaways I think from the buy side, just again for people that weren't here, is that there was a lot of talk about what it is actually that you do, in the sense that you are very much just geared towards and sort of measured on your P&L, and can be a good or bad thing. And I think that one of the takeaways was that they both agreed kind of that sell side starting place for people that are either right out of school, don't necessarily have a track record, or are just not sure necessarily that finance is their long-term thing, is a good place to start. There's a lot of sandbox to play in for sure. So that was from last time. In case any questions or anything we want to go over. If not, I will just sort of move it on. So the FX market, the FX asset class is at its core just a exchange of sort of two currencies, right? So again, thinking about what was the core of the commodities asset classes, the delivery of some raw input. Here, you have two people or one counterparty essentially that has some exposure in a currency and would like to get a different one, whether that is exactly at the moment in the spot, or further down the curve. One of the things I really want to highlight here is again is the size. So again, we hear all about equities, and we sort of pointed to the volatility in the commodity markets as being an attractive reason to maybe go there. The size of the FX market is massive. So the BIS, the Bank of International Settlements, is effectively a central bank-owned entity that is responsible for a host of reporting and sort of monitoring the health of the foreign exchange ecosystem. But so they release things quarterly and every year. So I just grabbed this, a grid from this, or a screenshot from this, the website, to kind of give a sense. But if you think about, per day, and this was in 2019, so obviously volumes, I think, have exploded through COVID and sort of the economic recovery across the board in equities, credit, commodities, as well as FX. But going back to 2019, you saw about just over $6.5 trillion worth sort of traded on a daily basis. If you look at the total estimate of total holdings, they have this 2.4 quadrillion number, and that's a lot, right? And when you think about the different ways to trade things, or where you want to sort of go, where you can have the most impact, size is a function. And so yes, volatility, especially in the G10 space, may be a little lower, but it's a big number, right? And as we'll see, there's a lot of leverage that can be accrued, for better or worse.
How does that 6.6 compare to the equity in the bond markets?
It's a great question. I'll get back to you on that. I think we said at one of the onset of the slides that the equity total market cap was, I want to say, roughly 20 trillion. So that's the total outstanding amount of the equity market cap in a global sense versus a daily turnover of just under 7 trillion. So again, things to think about as you evaluate what it is that you may necessarily want to go to as a first step in your finance or your trading careers. Forex is also a very retail-friendly market, whereas it's a little tough to trade commodities, very tough to trade credit as a average Joe, in your E-Trade or your Merrill Edge or whatever your Robinhood account. FX is actually very geared, and there are a lot of brokerages that are specifically targeting retail customers. So anyway, the whole point is that it is a very large market, and there's it is fairly efficient again in some senses, but there is opportunities that do scale quite well, because you do need that liquidity at the end of the day and someone to take the other side of what you're trying to do.
Did you have measures of how retail does on losing?
Well, so actually, Atif can talk about this. I was actually reading a book, I think it's called The Wizards of the FX Market, but there used to be, when some of these retail brokerages were offering, I think there was something called a B book, where they would just take the other side of the retail bet on the assumption that most retail investors lose money. And then when they needed to come out, they would just punt it out. And so I think actually Atif did work at FXCM, which is, he'll be able to maybe speak a little bit about it, but definitely in the years leading up to 2008, for sure, I mean, that was the common thing, where the estimate, they would just fade it, exactly. And obviously capital requirements, I think, and regulation around the retail market has become definitely more in scope since 2008. Everyone wants to protect the American consumer, but it is something to think about. I mean, on average, most people do lose, right? And there is something to being, despite, I think, last year, overall, the edge is still geared toward the professional institutional favor. So just things to think about. So again, at its core, what is, a trade in FX? So you can have the spot rate, which is effectively the current conversion, as well as kind of the forward rate, which is based on interest rate plays, right? And what you can receive or have to pay in this case of the existing negative interest rates in Europe to deliver that currency in the future. And so where you see people trying to gain edge in terms of transact in this space is you see people betting on the spot exchange rate. And so you could think of this, again, akin to the commodity side as like, what is the physical price of that asset, as well as the forward points too. So you see people that actually can make livings in trading the difference in interest rate parities, right? But at its core, kind of like how in the commodity market you had, a future, which is a delta one instrument that represented the delivery of some good in a future period of time. That is very similar to the FX market. And so, one of the ideas was, how do you start to generalize, and how do you start to be able to scale across asset classes if you're not a domain expert, but you want to be a quant trader? You can see how, especially in the fixed side, that there is some sort of structural commonalities, right? This idea of like a current price versus a forward curve. Can you take bets that are, sort of flat price related to the spot rate? Can you take calendar structure differences, which is in this world would be a kind of like selling the euro USD 1 month forward and effectively buying it maybe on the 1 year forward. So you're short the front end of the curve. Again, that all kind of plays out, and that exists in the rate world, right? You have the 2 year versus the 10 year. This all kind of has a similar feel to it. And that was, again, one of the kind of the themes that we were hoping to kind of go over this semester, was that it generalizes very well across a massive set of markets in the fixed space. So this is the same slide that we had from commodities, the idea of like, what is the difference with equities? Come back to it. I want to make sure I give Atif his full time. But some of these things are similar. You have the deliverability aspect, where you actually have to take the hold of the currency if you go through the valuation date. One of the things I want to touch on the diversification side is that, when you think about the natural producers or consumers of commodities, it was, you have the people like Shell that produce oil, you have the farmers, you have the people the t-shirt company that buys cotton. The FX market is actually so much larger, and you see that then reflected in the volumes, right? I mean, anyone that does anything in a different country is going to have some sort of exposure that receives, it could be just you guys. When you go, and if you're going on vacation, COVID's over, you want to go to Italy, well, maybe you think you should actually convert your dollars to euros now, because the euro is going to appreciate next year. So your euros will actually buy you more at this moment in time. Versus you could be Apple, and you could have billions of dollars of revenue in Asia. All that revenue is in a different currency versus, your USD accounting. So it's not, I would say that the size and scale of the people that have this exposure is different. And then on top of it, you have the spec community, and that's like your hedge funds and stuff, people looking to profit in the market just as a function of somewhere that you can invest capital. And obviously, the crypto space is kind of like I would say from an institutional standpoint, is a niche portion of the FX market, right? At its core, it's a cross pair versus the dollar, and then obviously cross pair versus the euro. And, we'll talk a little bit about it later, but, how does that translate to, your Ethereum quote in the Brazilian real? Those are all kind of the future things. Versus equities, I mean, obviously your blue chips are, pretty stable, low transaction costs, but the leverage and transaction costs in the FX market tend to be much lower than equities as well, much lower than commodities. And again, transaction costs and leverage tend to be a function of volatility and liquidity. And like we said, this is the market for that. So you can actually, again, thinking about where do you get your bang for your buck, you can transact as a retail investor with leverage at like 100 to 1, depending on some of your financial circumstances and depending on what you're looking to trade. So from an efficiency standpoint, it can be very good. And a lot of times fees and commissions, which are what really erode high turnover strategies, which at the end of the day, the quant trading field does gear towards, higher frequency rebalancing trades. This is a good place for it, because you don't get, you can achieve that 50 to 100 pip return and not worry about paying 20 to 30 bips in execution costs. The major difference though is sort of like the fact that it's traded OTC primarily outside of the futures market, and sort of the decentralization. This is something that Atif is actually an expert on, so I'm going to let him speak more about it. But the idea here is that, I think price discovery is not singular. For the majors, of course, there's going to be a true value that effectively everyone agrees on. You get something like the WMR prints. But as you start moving to more the fringes, a lot of times what the best execution price is not going to be standard. As you see, the liquidity pools that different banks are willing to offer is going to be somewhat divergent. And so this actually presents a very interesting opportunity to the trading side. I think something that's a little different versus like the hedge fund and sort of the buy side space. There's a whole careers and whole sets of opportunities that can be geared towards playing around in this sort of liquidity maximization problem. And that does take place in sort of like a lot of electronic trading in the sell side. So it's that sort of fragmentation is something that Atif is going to speak about, but I think I wanted to highlight it is one of those really key differences.
I'm sorry to keep interrupting, but is
By all means.
margin a performance bond in this business, or is it actual loan?
Margin in the sense of what you have to post. So there's no
100-to-1 leverage margin.
Oh, so that's in the sense that if you wanted that, you could effectively post, like I said, it's more akin to variation margin in the exchange, where you could effectively lever out. If you wanted to buy $100,000 of, let's say, Euro USD, you don't have to put down 1,000 per se, and then obviously you will be subject to performance calls based on how your position does. So that in that sense, it does function similar to like an exchange, right, where you post margin. It doesn't necessarily get daily settled here because it is OTC, but you do have the ability to lever past, what the initial outlay is.
So you can get in trouble as fast as
You get in trouble. So
long-term capital management.
yeah, exactly. So that was the big blow up. So you can imagine, I think in the late 90s, you have these carry trades where people are effectively short the yen, or let's say short the franc, especially going to 2015, and long some funded currency, and all of a sudden, the government depegs the franc and it mainly tanks. Those are that kind of volatility for something that was geared to be maybe a 10 bip, 50 bip trade. All of a sudden, you're now at 1%. That can actually hurt people that have been levered, much more than this. So it's something to definitely not take lightly, but it does, again, it's all about risk reward and what you are comfortable with as an individual. So this is a really good diagram that's I think overly complicated from the BIS about what the structure of the FX market is. But if you can, we're not gonna have to really go into all of this at the moment. But I think the key takeaway is that if you looked at this for equities, it's really just kind of like an exchange, and then you have a client on either side. This sort of complexity about like where people are interacting with very different sort of market participants is not there. And it's the same thing for commodities as well. I mean, what you gain in sort of that ease from transacting against a central exchange. You can sometimes lose, I guess, or you lose that benefit of having maybe some structural opportunities to gain some edge. So this is available. We can talk about it later. I mean, some of these things I'm not even as familiar with. But the whole idea is that this should be, for most other markets, kind of like one box and then a client on either side. So like I said, there are some complexities that if you really wanted to get into the FX market microstructure, there are opportunities. And it actually is very geared towards people that are coming out of school with math background, stat background, physics backgrounds. As this is kind of a sunk cost to a lot of major dealers and something that they're always looking to improve their abilities in. So I got through that in 20 minutes, which was the goal, so we can give Atif his time. So I'd like to introduce Atif Malik. He's been I've worked with him now for almost 4 years. He kind of is our main point of coverage from the sales side. So he's a director at BofA. He works in EFX Sales. If you remember that, again, most of FX now trades in some form electronically, whether it's a RFQ, which is a request for quote, or algorithmically towards fixes or TWAPs or whatever. Spent over 20 years in the financial industry, with the majority being the FX space. So again, that idea that he is extremely well-versed and kind of has that expertise. And like I said, so he's worked in many places. He worked at FXCM, which is again one of the largest retail brokerages, JP Morgan and BofA, I think, for the last 8 years. So he's based in New York, so he's been kind enough to zoom in. But he's going to speak a little bit about his experience, what he does, and then some of the nuances of the FX market, maybe touch on crypto, and then hopefully if you guys have any questions, I thought McCool and Thompson did a great job of answering anything. He's just more eloquent and more knowledgeable. So please feel free to interject whenever. And I will turn it over to Atif. Let me see if I can bring him. So should I stop sharing?
Yeah, you can stop sharing.
Okay, there we go.
There
Perfect.
we go.
All right.
Thank you, Max.
Look City.
Can you guys hear me pretty well? I'm on my little Bluetooth here in the office.
Yes, all good.
All right, perfect. Let me just crank you up a little bit on the volume. Yeah, thank you, Max. You should give me a little bit warning next time when you put me on a big screen. I'm Wasn't prepared for that. I would have worn a better shirt, to be honest. But thank you guys. I'm coming to you from One Bryant Park, 42nd and 6th Avenue here in New York. It's also where Max is usually, just downstairs. Max, I think, handled my introduction better than I could, but I'll just expound upon that a little bit. I am in the EFX sales role at Bank of America. I've been doing this for 7 years here. Prior to that, 8 years at JP, so 15 years in the two banks. Prior to that, I was at FXCM when I was actually before Employee 100. So before the terms fintech and startups and things resonated in the market, we were there building out the electronic FX platform. And actually, we like to think that we forced the hands of the big banks to electronify their FX space. So we're a little proud of that part. But coming back to where we are right now. So what does electronic FX sales really mean? It is a relationship management role, but it's very different than what you may imagine from like the movies in terms of like sales and trading.
Could you turn him up a little?
Yeah, could you turn it up?
Yep.
Also, I like screwed up.
We lost you a little bit.
I don't know where the.
Feel free to interrupt me at any time, of course, because.
Yeah, can you turn him up? I don't know how to.
Yeah, I can't do it from here.
Yeah, so we're coming off a little light on the volume.
I can move the mic a little bit closer if that helps.
We're good. We're perfect.
Oh, okay, yeah.
All good.
That's good.
All right, go ahead. Sorry.
No worries. I was just jumping into what we think electronic FX sales means, and it's not akin to, I think, like the old movies of Wall Street, where we have sales and traders and how we're moving deals. It's much more precise, much more systematic. My primary mandate is working with a set of clients that are systematic in execution and how they approach the liquidity in the FX market. That touches upon quite a few things Max brought up, and I don't think we can cover that in one class. But there are buy-side clients that we work with that approach the FX market in a very measured manner in terms of like expressing their intent. So if they need to buy, say, 50 euros or 100 euros, long gone are the days where a senior PM will have 6 junior traders around a desk. Each one calls their favorite banks and works a bid offer. That open outcry system is long gone. Instead, that system is now your algorithm, your OMS, as we like to call it, your order management system. So when you have 100 million euros to do in the market, you have a couple factors in terms of like how you like to access that liquidity and what kind of market impact you would like to have. So one of the standard ways of doing that is something like what we would like to call like a TWAP, like a time weighted average price. So you take your intent, slide it over X amount of iterations, and execute that in the market. That sounds nice and very upfront and pretty simplistic, but we get measured, and my conversations really in the sales role is measuring my market impact. So what we like to say is the first execution from a client is at, say, X rate, but let's say the 30th execution, which is the 30 million, or could be like the 75th million euro, is 10 pips worse or 10 points worse. Pips is in the 4th decimal spot in the euro dollar. Usually was the lowest iteration of a market movement, but now we actually work in 1/10 of a pip, so the 5th decimal spot. But we will get measured saying, hey, listen, we traded with you, and then all of a sudden the market went against us, making the next executions more expensive. Those are real conversations we have. That is a direct product of having defragmented FX markets. The spot market, which is the T+2 or T+1 settlement, with no forward points, is heavily defragmented. There is no similarities to a New York Stock Exchange, a NASDAQ, a CME, CBOE. It is pools of liquidity where we have quants whose primary jobs, teams of quants, whose primary jobs are to find the best way to access the liquidity and construct the price. So if I'm jumping around quite a bit, jump in, feel free to interrupt me. This is really, I want to make sure that you guys get enough from the takeaway. But what we're doing is constructing pricing ladders. So there's what we call a top of book. So what is the price at 1 million euros? That is actually the most heavily transacted amount in the FX market, what we call top of book, which is 1 million base currency. So 1 million euros against dollars, 1 million, say, an equivalent like $1 million Canadian. So it's $1 million against Canadian. That is, I think, about 2/3 of the market as it's executed. And that's also mostly because even from the retail space, 1 million lot at 100 to 1 is, like 100,000 margin. I'm sorry, 10,000 margin that you can trade. So a lot of retail folks trade top of book, but also top of book is, because of liquidity pockets there, the number one venue or the number one size that systematic traders use. And so that's your first point. The next point is, where do you price 50 million euros at any given time in the market? Where do you price 100 million? Unlike equities, where the bid offer price shrinks with size with blocks, FX, because we're seeking liquidity and we're going outwards, the price actually expands the more liquidity that you need to execute upon. So if you're trading 1 million euro dollars, you might be trading on a 0.2, 0.1 wide spread, which is nearly at mid. Whereas if you want to trade 100 million euros, let's say right now, given this time at 12:30 in New York, you might be sitting at 6 points wide. So all of a sudden your bid offer spread has actually expanded quite a bit. So now you can also start seeing the game here a little bit in terms of execution. Is it better to trade 100 million right now and pay the 6 point spread that you see? Or is it better to embrace a little duration risk and slice up your intent in ones, fives, and tens? So that kind of just in a nutshell is like one of the primary needs that we need to overcome in the FX market, not only from the sell side, which is Bank of America as one of the primary banks, but also as a buy side client. And the buy side clients, and Max asked, offered me a couple questions. What is a buy side client? Buy side client on our side is not only the hedge funds with all the names that you obviously know, the CTAs, the commodity houses, but also the big asset managers like the PIMCOs, the Bridgewaters, the Franklin Templetons, the Fidelities, things of that sorts. They're also in the FX space. Then adding a new wrinkle into this, and this goes into why people are in the FX market, are also the corporations. So Max touched upon the ATM example, where if you're in Europe and you need to take out 500 euros to go out to dinner, you're actually putting through an FX transaction where you are selling, let's say you're in Texas or New York, you have a dollar account. At that ATM transaction, you are selling a dollar equivalent to 500 euros at the rate that ATM machine and that bank determines it should be. That's an important transaction because that is a non-alpha transaction. And that's one of the biggest distinctions in the FX market. That's what the corporates, as well as payment flows, as we call it, they have a real need to actually convert currency. Some will call soft flow, but that is a massive component of the FX market. Today is actually very apropos because the spot settlement date of each calendar month, the last spot settlement date of each calendar month, which is in general T+2 settlement, is today. That is when most of the US corporations have to rebalance their portfolios, that is, sell their foreign currencies that they've earned in different countries and bring them back into the US so they can apply it to their balance sheet. So today is, we just actually finished at the WMR fix at 11 a.m. New York, an extremely busy day where most of the corporations you can name in America have sold their foreign currencies and brought them back into US dollar accounts. So that is all non-alpha flow.
So yeah, so what he means by that is he's also, it's versus end of month, right? And so he was saying that the spot is effectively delivering for cash delivery versus the 29th, which is the last business day of October. So a lot of those, like I said, the Apple example, for whatever their decisions or the reasons, they're trying to bring back those profits from afar and effectively buying the US dollar and selling foreign. And so actually, this is a structural play. And we saw, I think it's some decent foreign weakening going into this. So WMR is thinking about is effectively a service. There's hourly fixes, but the 4 p.m. WMR, you can think of that like the settlement, the 4 p.m. for equities. Yeah.
Can you front run them? Like, if you know that they happen.
Well, so we don't want to front run, but it's known that it's there, right? Like, so you, for example, could go look at some historical spot data, and you could think that this is a good trade, and you could effectively go and sell 1,000 euros on leverage. So you only need, let's say, 10. Go sell 1,000 euros at, call it 9 a.m. New York. So let's call it 2 p.m. London, and buy it back during the fix. Very possible. And the thing is, like, that from a trading standpoint, that's actually a very big question that you have to deal with. So, if it's something that's widely transmissible, so kind of like the roles that we talked about in commodities, it's very, very transparent. Everyone knows it's there. Why should it continue to work? And then let's say that you think it works and you're going to do that trade. You're going to do it early. Well, how do you know that there's not some, AQR that's going to do it earlier than you? And so, that sort of becomes like a recursive function of like, where does the ball stop of what is the true time to actually do something, or what is the true time that we think that this phenomenon actually occurs? And there are people that spend whole times on that. Like, I think in equities, like index rebalancing is a very big, very similar thing. That index is going to rebalance in a transparent, everyone knows it, what's to say that you shouldn't do it, 1 hour early, or you shouldn't necessarily buy those 3 days early? It's a decision that you have to sort of come up with as your own trading side. So anyway, sorry, go ahead, Atif. We got off topic a little bit there, but continue on.
Oh, this is ideally how the conversation should go. But I think one of the questions that you brought up, Max, and one of the questions that you posed to me was actually one of the more important ones, is like, why be in the FX space? And I think the idea that not everyone is trying to make a profit on their transaction or their intent to do a transaction is a very key point, because you do get days like this, or actually throughout the month, you have corporations repatriating revenues, profits, losses, profits or whatever it might be. And it's not just in the US, like tomorrow will be Canada because of their T+1 settlement. The Europeans have their own way of doing things, as well as like the APAC region. The other one is models, if you want to say like PMs who run quantitative models where they trade FX as a primary asset class. So they, in and of itself, look at FX and look at the relationships and execute based on what their models are. So this is more than just being the super fast names that we all know about, for lack of better words. It's not the latency arb, it's not the stat arb names that we know that are in Chicago and down in Texas. Actually, you got one of them there as well. This is more so like, like say name any of the big hedge funds has a couple quant PMs, and they just have a computer. They have a model that they've been building with their quant engineers for months, years, whatever. And they're just trading FX in and out, be it on an alpha horizon, which is an expected time for each trade to mature, say in a couple minutes to a couple hours to multi-day. Their time horizons can be that short, and they're trading for 0.5 to 0.75 basis points on average, and running proper risk metrics with that. So that's they are substantial amounts of flow in the market. There are probably, just from my experience, about 6 massive quant PMs in the space. AQR used to be very large. I don't know what happened to them. We'll figure out about that one. But they are incredible partners in the space, because they realize that they've become a fabric of the liquidity offering and the structure of a lot of banks' FX liquidity, just because of the amount that they trade. So we partner, and one of my jobs is to partner up with a lot of these PMs to make sure that we are at a good middle ground where they can execute and capture some alpha with us, and we don't cause market impact, but also we partner with them to make sure that when we provide liquidity, they're not just basically shoving the market in our face, and our auto hedgers have no chance to either come out flat or maybe a couple ahead, because everybody's for profit in this equation, so we have to find the right balance. Another aspect, we can dive into that if you want to, in terms of like the quant space, because I know that might actually resonate quite a bit with the audience right now. But another space for FX also is a lot of the relative volatility traders, so the option traders. It doesn't necessarily have to be FX ones. It could be interest rate options. It could be equity options. So if you are a PM and you're covering multiple countries, for example, and you decide to put on actually, this is a very, very current example. Let's say you put on a China option on the offshore deliverable, which is CNH. You have a big commodity play on. You have a commodity bias, be it positive or negative, or let's say in this case, you expect commodity prices to increase, which should drive more demand for CNH, because there's gonna be more investments into China, for example, as an example. You may need a hedge out. You may buy an option where you buy a dollar, or you might sell a dollar put. So you want to be able to repatriate. Well, actually, when the trade is over, you want to be able to have a floor based for when you sell your CNH profits and buy dollars. So you want to have a put where you can actually get those dollars back in a fixed manner. So there's a lot of option traders out there as well in the space. And that continues. Like, you can also do the commodity blocks. So this is where FX can get a little bit more fun with the baskets. Let's say you want to play the commodity boxes. You could do China, Australia, New Zealand, Canada, and a couple of the Scandinavian countries, because these are all commodity-based countries. And you can build like your own little basket of correlations in terms of like, how do you want to trade different commodities against different currencies against, let's say, dollars, and then build that framework out completely. So yeah, we may have clients that are systematic in execution that have primary FX models, or they could be systematic in execution trading a relative vol model based on commodity currencies. So I'm hoping I'm explaining that a little bit clearly. If not, just please jump in and ask me questions.
So we have a question. Just, so I mean, that was a complicated deal structure, that he's mentioned.
Sorry, didn't mean to go in there.
A lot of the nonlinearity and, correlation trades is kind of like in that exotic bucket where it is a whole thing. It becomes more niche. The liquidity does tend to go down a little bit, and the people that do it are far and fewer in between. But that is like a possible derivative structure, right? There are people that, again, make tons of money, very successful careers doing things like that. So the question then, maybe I'll pivot a little bit to the personnel side is, so as a little bit of background, a lot of PhDs, some undergrad students here that are considering finance. Where do you see kind of like the top quantitative talent wanting to do in the FX space? Is it going to hedge funds? Obviously, crypto is a big thing. Where would you suggest like the hot area is right now?
Absolutely. So let's start with the sell side first. So at a big bank, I can actually say when I was at JP Morgan, the guy who sat behind me was a particle physicist at Fermilabs before he showed up. And he was building our auto hedging strategy. So basically he was using his physics background to data analyze the FX structure on a microsecond basis to figure out what the opportunities are and how we can find advantages in the market price. And I guess this goes back to being a decentralized market. We don't have the exchanges. We have primaries, which is traditionally Reuters and EBS. That also is falling apart. There may be 6 to 8 primary liquidity venues out there. Not on top of that, one of the things that the big banks are doing because of our flow, like Bank of America and JP, and Citi, we are building our own, almost like an internal pool of liquidity that we offer to select clients because we know they're very good flow, or let's say we want to win a bond mandate from a very large corporate, we'll show them really great FX rates just to help sell our case. So price discovery is one of the biggest things. So we have a group here on the floor, just literally 3 rows over, called the Quantitative Strategies Group. They are looking at price microstructure. So what they're doing is analyzing a tremendous amount of data. And FX is it's probably one of the best asset classes for this, in the sense that it has the most continuous data and the most of it, because the spot market is continuously priced from Sunday 5 p.m. New York through Friday 5 p.m. New York, 24 hours a day. So it has the most data points. It gives you the biggest data set and the most continuous data set to work with. So there's, like with equity markets, you can pull prices if there's an event shock coming out or an event coming out for an underlying equity. If, like Max alluded to earlier, the Bank of Switzerland, the Swiss bank can't defend their peg anymore, and they lose the peg and the floor falls out of dollar Swiss, which they were trying to keep it, let's say like dollars to Swiss was like a 1 or 0.99, it falls. Ripples through the markets, like all the Swiss banks lose their hedges, the market collapses, FX is trading. We traded through it. That was actually our last biggest shock in the industry. I think it was 2018, 2000, it was that long ago, 15. I was actually working at JP at that time. That was a good time. But it was for 24 hours. We were printing markets the best we could. Presidential elections, the UK Brexit referendum. We worked continuously through the nights, making sure that our traders are they're making markets where they can, because liquidity needs to be printed. Clients do have trades to do, and the clients could be central banks, for example. So it's not just the corporations and the fund managers that we're working with. It could be.
So we have a question for you.
Yeah. Go ahead.
I don't know, a lot of the stuff you said, like, couldn't really understand them, but I just was wondering, like, is there a consistent way for like retail investors or like laymen to make money off Forex, or is it all like speculation?
Did you get that?
I believe I heard it's like, if the retail, is it consistent enough for retail investors to make money in the FX?
Yeah, so gotta pivot. Like, you have all these things, and you have.
Is it a safe bet?
Is it a good market for sort of like retail, call it maybe day trading or even short-term investment, given some of the things that you've been talking about?
I think if you come into it very new, a lot of the flows that move prices and may actually stop you out may be unknown. It could be option experts at 10 a.m. It could be the Mexico, like if you're in dollar Mexico, it could be the noon expiry. The WMR, like today is a big dollar day normally. Dollar demand comes out of nowhere, and you're like, why is that happening specifically at this time of the month? It's tougher. I know from the retail's perspective, there's a lot of algorithms out there. I mean, some are prepackaged, some are actually very intelligent, and there are quite a few people that do make some money on it. Most of it's expressed, either through direct APIs or, even like the MetaTraders. I'm sure you've come across that if you've researched the retail space. Like the MetaTrader platform has prepackaged algorithms that you can then form fit to what you want, but it's possible. I'm not going to say it's not possible. I mean, the institutions can run you over with specific flows. I mean, if somebody's moving 600 euros right now and you are against it, there's nothing you can do about it, and that won't be apparent in the price move in the market information you get aside from the price move.
I think
that's the toughest part
in the macro space, especially. Like, I think you need to be much more confident in your understanding of that market if you're going to do it as a retail side. If you go trade your Robinhood for equities, right? In reality, there's a very inherent bias for that to go up. So even if let's say you're not doing anything short because you don't want to limit losses, so you just buy even a single name stock. The reality is there's going to be a decent updraft to that stock from just the general equity market. When we talk about the commodities and in FX as well, the benchmark is not a guaranteed line upward. So you do need to understand, I think, a little more about each individual market that you're trading. Similar to his point also, like that flow thing is a big deal because that also, depending on how you're levered, what your margin is, what your economic standing is, you could be on the wrong side of a 50 bip move, and depending on how much you have, that is not going to be necessarily apparent versus, again, thinking of that equity mark where if the S&P is up 5%, likely no matter what you bought on a single name basis, it will probably be up minus any specific headline. So I think it's an interesting thing because I know a lot of people that do it as a retail side. It's just I think you can trade like cool technically as a retail trader in the sense it's just his own money. Like you can do all these things. It's just a little bit of a higher risk, and I think given how few the markets are, you do want to have a little bit more of an expertise. And then yeah, it's just as winnable as any other market, right? Technically at zero sum, but it's just like you said, there's some tail risks there that get introduced that are a little higher than your traditional, S&P Russell kind of investments.
And I think that's a good point, Max, because that highlights like one of the most prevalent strategies is actually the short-term mean reversion. Right. To address these spikes that most people don't see coming because of the specific flows in this market that can move 20 bips, 40 bips, 50 bips against you.
Yeah, especially in a lot of the developed markets too. Like there's such a prevalence of algo trading, which is all text parsing. There's a lot of algos that are based on actual tick price exchange. So today actually is a great example. The Bank of Canada had a rate decision, and they were very hawkish compared to what expectations were. The CAD jumped about 50 bips immediately. That actually is probably a good fadeable move, right? But depending on where you were, do you have the capital to really stick into that? It's a great question. But yeah, that short-term mean reversion, especially in the G10 space, is very, very prevalent. But that's, again, you're kind of calling a ceiling or you're catching a knife. And, to the extent you want to do that as a retail trader, it's up to you. So we have 5 minutes left. I would like to get really quickly back to the question on so you kind of went through the sell side. And again, I think the FX space, again, given the fragmentation, is one of the areas where there's not as much of a difference in being in the risk management space as well, or versus like the quant side. I think that the quant talent is very, very highly prized in the FX space, given how sort of algorithmic and electronic the execution is. But so on the buy side, what would you say to that?
Well, buy side is actually very interesting because it's not necessarily pigeonholed to say I'm going to be a quant trader where I'm going to work on various correlations, find like background to it, find the historical correlations and trade, find alpha signals off of that. I mean, FX also is and always has been the primary venue for expressing geopolitical and macroeconomic news. So like Max alluded to earlier with the dollar turkey, central bank governor, Prime Minister Erdogan actually is rattling his saber. Traders are trading dollar turkey or euro turkey first. So there are things of some sorts where you can build like a model where that literally data reads. I mean, that's actually pretty common out there right now where you have a data reading model, something that's more subjective. Obviously, the traditional models that you guys probably know better than I do in terms of like iterative models out there that operate in the FX market, trade different correlations. I have FX. I mean, FX, to be honest, has been very low vol most of this year. I guess as like it's settling down after last year's pandemic trades. So most of the FX traders are actually moving on to different asset classes. What are they doing in the metals? What are they doing in nickel? What are they doing in interest rates? The interest rate market's starting to shake up a little bit. Like right now with Bank of Canada that Max just mentioned is now, what's the central bank game? Like who's going to raise the interest rates first? And that's important because that's yield, especially in the context of currency versus currency. If I buy, let's say Canada increases interest rates to say 2% or whatever it might be, and US is still at 0.5. If I buy dollars and sell Canada, my trade is a long dollar CAD, I am financing that trade at negative 1.5% on a top level over the 12-month period if I hold it for 12 months. If not, it's actually charged at a 265-day basis divided by that. Right now, the top trade out there there are quite a few quants out there, macro quants, trying to figure out what is the play in central banks, because we've had about a 4-year to 6-year stagnant central bank policy globally. And now we're starting to see the changes happening. Our chats right now with our macroeconomists and our quant strategists is about, is it ECB? Is it CAD? Is it England? Like what's going to happen? So models are being adjusted. Models are being set to compensate for that, to see if they can sniff out who's making the first move. Is it in the interest rate market? Is it in the underlying equity markets? Are folks selling more euros than they're buying cable, or I guess GBP sterling? Sorry if I'm using little short terms here, but been in this space for too long. But it's a world of opportunities, especially when you can look at correlations across multiple asset classes and trying to find an alpha signal there. So hopefully that helps, man.
Yeah, it was great. So I mean, I know that's like 11:50. You have you can pause there.
Yeah, we're supposed to finish, but we can hang
If
out.
anyone has any questions, yeah, we got one more question.
We were to talk about what he thinks of the crypto space.
Can you talk about the crypto space a little bit and what you know?
Yeah, I mean, this is something. I mean, we are, as the banking industry, the big banks, I should say, trying to figure this out. From our perspective, like we want to be in the space, we just have to figure out what's important to clients. So currently, what we're doing is we're surveying our top clients, like what we don't even call them clients, we call them our strategic partners, and at Bank of America, to figure out what will make them participate in the crypto space, and they want to. That narrative has changed quite a bit in the past 4 or 5 months, from like that'd be nice to we want to get into it. And it's about who's going to figure out the custody portion. Is NDF the way to go in Bitcoin or in the crypto space? And we don't think it is, from what our researchers are saying. So it's about figuring like, how do you house crypto as an asset? Once we figure that out, I think it will open up the institutional wallets. That is the real money wallets, as we call, like like the BlackRocks. I'm just naming names, and just naming big names out there, like the tutors, like Citadel. Ken Griffin was up there recently. He's absolutely against trading in cryptos, but then he was speaking at his university, I think 2 weeks ago, and he said, you know what, if they're regulated, I'll trade it. So that's where we're at right now. We obviously think we're well behind as an institution in the game in terms of like being involved in the crypto space, but we are now fully engaged in entertaining ideas and trying to find a path forward. I don't know the answer, and I don't even think our chief strategists know the answer on how to do it on an institutional level. But we do think there is a tremendous amount of assets behind it that are willing to look at it, even from just like a traditional gold hedge or an inflation hedge, like buying power hedge. So I wish I had a better answer, but I don't think we have a better answer right now.
Good answer.
It is interesting though. Also, I mean, like once that kind of money does enter the space, though, like does it become less attractive for the current people that are trading it, right? I mean, going to his part about the flow, you see that whatever 600 million in Euro USD moves at 40 bips. Well, what does 600 million in crypto do, right? That it's a very different scheme once you start to get that access. And I think, you saw the first, the future was listed probably about 3 years ago, maybe. I can't remember exactly when. That has started to get a lot of interest with the ETF that was launched by, I think, JP, right? And it has like 500 million now in assets. Like at some point, the question is like, when does the financial market around a certain asset outweigh that actual asset's value? And this is going back to last or 2 weeks ago, the crude thing, right? The value of crude was never negative by far, like 1,000%, I'll tell you it's not. But the amount of financial money in derivatives that are related to it pushed it all the way to minus 37. So that's, if right now the crypto space is, I think, attractive, a lot of volatility, a lot of headlines, but there really, isn't that kind of institutional wallet investing in it. And when it does, that tends to push out like a lot of people for sure. So like I said, like Atif said, I don't think that the institutional space has really like come to a decision yet, or like how to best offer it. But it will be very interesting, kind of like 1 to 3 years probably, right? As the technology develops, the market develops, the allocations develop. So anyway, for whatever it's worth.
Well, I'd like to thank both Matt and
Thanks, Steve.
Thank you very much for.
Thank you, Tiff. This was very great.
Feel free to reach out to Max at me. I'm on LinkedIn. He can get you my details.
Yeah.
Happy to continue conversations, always.
As always,
Thank
any
you, guys.
questions, I'll forward on. Thanks, Tiff. Just to, I guess we'll just round it out, just going back to the thing. So I don't need to really share it. Just quickly, I'm not sharing the screen, doesn't matter. I think there's really one class left. I was talking to Dr. Dolman. I mean, this was kind of the end of the sort of scheduled syllabus that we'd come up with. So we'll probably wrap up on the 10th. And then I think that will kind of be it for the semester. So, thank you everyone. It's been really great. It's been fun for me. So, and like I said, if any questions about anything, I'm always willing to get, shoot me an email, text. And if you want to talk to someone that's been here or questions, I can always help point you, hopefully in the right direction, and we can go from there. But turn it over, Dr. Dolman.
Well, we'll just leave it off here today. Thank you, Max.
Yeah,
Appreciate it. Very good job. And we will see you guys next time. Thanks for sticking around and for being interested. We appreciate that. And you guys are dismissed. Thank you for coming in on Zoom, guys.